Okay, so welcome everyone to the third session of the Climate Finance and Carbon Pricing webinars that we are doing from June up till August this year. And today I'm really excited to welcome our esteemed guest speakers from all over the world. And I would like to hand over to Dolphine to do a little bit of introduction. And just so everyone knows, today we're going to be talking about private sector involvement in pushing for green financing. If you have any questions, please always remember to write them in the chat below, and we shall be sure to direct them to the guests that are here with us today. Over to you, Dolphine.
Thank you, Maria. So hi, everyone. So my counterpart, Maria, and I, and Jorge, we're from UNGO, and we're organizing this youth webinar series on climate finance and carbon pricing with the aim of capacity building people across the globe, especially the global youth, and especially the youth of both the global south and then the global north on issues of climate finance and carbon pricing. So for this session, we are going to dive deep into the role of pricing for green financing. So I think with the negotiations up to the of parties, we know space is shrinking CSOs and open for the sector, and people don't issue finance as basically issues of basically giving money, but it basically people want to see a return on investment. So that basically those who mobilize resources such as the GCF can be able
Dolphine, I think you're frozen.
To mobilize the adequate resources. And I think as of
Okay, I think she's having some internet issues. But basically she was giving a background as to why we are doing this and shedding some light on what the Green Climate Fund has been doing the past years and how young people have been involved in the lobbying process. And so that is really the background as to doing this session, because we haven't had time to speak about what does the private sector pushing for financing for climate action related projects. Okay, Dolphine, you're back. I just picked up from where you had left off.
Okay, yes, like I was saying, we're looking to dive deep into what this group of people brings to the table when it comes to issues of climate finance, and how basically they can bridge that gap that is remaining according to the amount of resources that has already been mobilized and dispatched. So the way forward, because climate change is not a one-time thing. So I think for this session, we have a very rich panel. And do, because they are very key players within the private, who is Mr. Edward Mungai. Mr. Edward Mungai happens to be the CEO of KCIC, Kenya Climate Innovation Center. So Edward, I will give you the floor to basically inform our viewers and basically all those who are interested on the role of private sector on issues of climate finance and issues of green financing, to basically tell us what you do and a bit more about yourself. Just a brief introduction. So, Mr. Edward.
Well, thank you very much, Dolphine, and thank you for having me. And well, talking about green financing and private sector, well, this traditionally have not been very active area. Well, one is because of lack of awareness, but I think also is lack of innovativeness in terms of the instrument that you are using to fund this kind of space. Now that said, you realize that the kind of people that I'm trying to support are young people who are having interesting ideas that can be able to help us mitigate or adapt to climate change. That said, then they must have that spirit of entrepreneurship, and they must be thinking about setting up businesses. So indeed, we are in that space where we are trying to catalyze the private sector through young people who are coming with innovation, and they put their ideas into the market. Now, therein falls the biggest challenge. Not many young people are having the finances. Not many young people are necessarily business trained and they have a capacity to run businesses. Therein, there is a challenge of governments listening to these young people and their innovations. Because all over the globe, policy is always behind innovations. So basically what we are saying is that the young people will come with brilliant innovations, but then the governments and government agencies will not allow them to put those products or services into the market, because then there must be a protocol that must be followed. And to make that protocol, government is a bureaucracy, it takes many years. So again, that's one other challenge. There is also the challenge of lack of facilities in the sense that I'm a young Kenyan. I want to come up with a cook stove that should help millions of women in the continent of Africa to have clean cooking. But indeed, to be able to make that, then there is a challenge in the sense that I can't be able to test how efficient is my cook stove. So you need a facility that you go into. They tell you how you can do to optimize your cook stove. And therefore, from that, then you can be able to push it forward. So that also is a challenge. And then finally, challenge number 5 is lack of information. They still don't have the information that will help them to optimize their business model and to push their businesses forward. So that said, in summary, young people or people who have innovations that are green in nature, they face 5 challenges. One is lack of that capacity to be able to develop their business plans and to be able to have a strategy. Second is that government are not listening to them, so we must be able to provide them with an enabling environment in terms of policies and standards. The third thing is that we must provide them the information they require to be able to push their ideas forward. For instance, we need to be able to provide them with somebody in India is doing, or in the US is doing X, which is almost related to mine. Let's try to see how we can share knowledge and grow it, of course, respecting the issue of intellectual property rights. And also, there is also the challenge about the facilities. But therein, I've just talked about 4, because then the 5th one is what we are talking about today, which is access to finance. And access to finance to these people, the problem is that we still deal with what we call plain vanilla financing, not recognizing that the kind of businesses we are dealing with, first of all, you need to de-risk them, you need to get them to the early stage, you need them to scale, or to have them in the growth stage, and then they need to scale. So if I'm a commercial bank, if I'm a private equity fund, if I'm GCF, I need to listen very carefully. How can I structure my financing instrument so that then it can help these people to scale their ideas? And what am I talking about? A young Tanzanian who is trying to think about making packaging biogas might have a brilliant idea, but then he needs to prototype. He needs to see, can it actually work by building 2 or 3 prototypes? So therefore, he needs somebody, or she needs somebody who can go in and give what I call proof of concept grant. So this is kind of soft money, is a grant. Try. If you succeed, you know what? You get more money. If you fail, what happens? We write a good story and we say it failed. And therefore, nobody will ever put money in that area unless there is some tweaking. So that component of saying you need to put in proof of concept financing, that can be a grant. And that's why the blended financing is very important. Then the next phase, if you succeed, as I said, then you must make 10, 20 items or biogases that you put onto the market. So that indeed the doubting Thomases can be able to see that indeed your product is working. But then you need even more money. So in that case, then you will have what we call early stage financing, which is flexible. You don't ask for security or collateral because these people will never have collateral. It must be at conventional interest rates. it also must be coming with technical assistance, because it's not just about the financing that you are putting in place. You need also to roll your sleeve and help these guys to push it forward. Now, if they succeed beyond that stage, now we can start talking about impact financing. We can start talking about private equity. We can also talk about commercial financing, and even we talk about DFIs. Now, the problem is that when a banker is seated, is waiting for a cooked idea that should be financed by commercial banks. It never comes. So therefore, then in our mind, we must be able to have a concept that I call conveyor belt concept, meaning you move a business from proof of concept, you move it to early stage, and you grow with it, and you keep on supporting it. And that way, then you enable to unlock financing, because then in another couple of 2 years or something like that, commercial banks will be able to put money, and that money can qualify to be what is called green financing. Unless we do this, we cannot be able to achieve our goal. And this is what Kenya Climate Innovation Center is built to do. We are funded by the Danish government, together with well, in the beginning we had the UK government, now we have the European Union, which is supporting us to put and to help people putting all these 5 things together. That is financing, that's access to information, that's access to facility, enabling environment, and business capacity building or business advisory, and also the financing part of it. And therefore, we put it under one roof, and we listen to people, they come with ideas, we try to shape those ideas, and hopefully we can be able to transform our countries, and we can be able to make the future generation to become more safe. So in summary, that is what we are doing. Well, in terms of my background, I've been working for KCIC since inception. I was one of the founders in 2012. We've been there for 8 years. It was the first CIC in Africa, in the world. There was about 8 which were established in various places, and they are all doing their own things and in their own different ways. And we started with 4.5 for climate financing. Today, I'm happy to report that KCIC is totaling about $50 million US, which is being put in to help young people and to come with brilliant ideas that would help us to deal with our climate. Thank you.
Thank you, Richard. Sorry, Edward. I don't know why I keep calling you Richard. Thank you,
That's fine. No
Mr.
worries.
Mungai. That is a lot. I think for me, for someone who wants to say that she's a youth who is in this space, we can see it takes a lot of processes, because when you explain the conveyor belt or conveyor belt process from the first inception to the proof of concept to the last bit. Just one quick question. Do you think we as young people, having interacted with, I'm sure you've interacted with a couple of young people, do you think we have the patience to go through all these processes to acquire basically this financing that we want to basically to help us to help us push for a green economy? Because in just a brief second, do you think the young people that you work with, do you think they have the patience to follow all these steps?
That's the elephant in the room. That's what gives me sleepless nights. And why does it give sleepless nights? Because it requires passion, it requires drive, it requires courage. Many of the young people are not having that courage, and I give you an example. You will be able to back a young person. They tell you, and of course, especially from our continent, because many of the people who are coming to me is because 3/4 of them is because they have missed a job. So therefore, because of the unemployment problem is why they come to me. And we work overnight, we work, put more money, put more effort. And then month 10, the guy tells me, you know what? Safaricom, the biggest company in East Africa, have offered me a job, Edward. What do? The guy jumps, you know? But if he was passionate, if he had the drive and the commitment, then we had moved. That, though, doesn't mean that we don't have some who have been successful. There is indeed many who have been successful. In fact, a lot of the time that I'm spending is evangelization, telling young people there is an opportunity. You can look at entrepreneurship, and for that matter, climate entrepreneurship as an alternative for job creation. And you can have exciting careers. So indeed, there is some opportunity, but also the biggest nightmare is that some of them are not very committed and they can't wait for 2 years because they also want things in an instant. Thank you.
Thank you very much, Edward. I think I have a lot of questions, and And even if I look at Maria and Jorge, I think we all have lots more questions. But for the sake of time, I will give the floor to Miss Athena. Miss Athena is from she will tell us where she's from and where she's worked with, because I read her profile and it's very interesting. She's worked with really some very big organizations, and I just want to give her this opportunity to introduce herself and basically tell her, inform our audience what she does in relation to issues of climate finance. And yes, so Miss Athena, the floor is yours.
Hello, everybody. Good morning, good afternoon, and good evening to friends and colleagues listening. I'm going to speak about what I do officially during the actual session. But for now, I want to tell you that I'm originally from the Philippines. I am based here in Rockville in Maryland, just outside Washington, D.C. I've been in the U.S. for 12 years. Now I work for a venture philanthropy called the Growald Family Fund, and we are 100% focused on climate change, particularly in the transition to a clean energy future, which is the subject of our conversation today. Before that, I was the finance director for the World Resources Institute and led the climate finance work. And for 15 plus years, I started very young, like you guys, so you can start very young. Have been involved in the climate finance negotiation. So I always tell my friends that I'm a recovering climate finance negotiator, because I've taken about 4 or 5 years of a break after the Paris Agreement negotiations ended, which is quite intense. And so I'm trying to still do climate finance work from the philanthropic and nonprofit side.
Okay, so that's very interesting. So you basically moved from being a negotiator to working for one of the very reputable organizations, WRI, and now you work for this very also interesting organization. Thank you, Ms. Athena. I'm sure we have a lot of interesting discussions up ahead. So for the sake of time, I'll hand over to Jorge to take over, introduce the next guest.
Thank you, Dolphine. So thank you very much for the previous speakers. I would like to introduce now Marilyn Waite, Program Officer in Environment, William and Flora Hewlett Foundation. So I'll leave the floor to you to give us a brief introduction about what you do.
Hi, thanks for having me. My name is Marilyn Waite, and I lead the Climate and Clean Energy Finance portfolio at the William and Flora Hewlett Foundation. Should I share my screen at this time? Should I go into the presentation?
So first, okay. So yes, we can go with the presentation now.
Okay. So please bear with me as I share this. Okay, can you see my screen?
Not yet. There it is.
Okay, it just takes a little time. And is it in slideshow mode now?
Not yet, but let's give it a couple of seconds.
Okay.
It's not coming up. We can see the slides, but the slide I think the slideshow is.
Okay, let me see if it's. Let me try one more time. Is that better?
We can see the presentation, but not the slideshow.
Okay, is it okay? Can you see enough or not so much? Do you see the second slide?
Yeah, we see the second and third slide, but I think for now it's fine. Maybe if there is another way of moving up to the slideshow, I don't know. I think it'll be okay with this for now. Let's see.
Okay, is this bigger like this? Is it better?
Yes, that's better.
Okay, let's improvise here. Right, so let me walk you through a little bit the kind of major problems. I will try one more time. Is that better?
Yes, there it is. Now we have it.
Okay. Okay, perfect. Okay. So the context is that before COVID, at least before COVID-19, emissions continued to rise. And even still, we're looking at an 8% drop in global emissions with COVID. We need about a 12% drop year on year between now and 2050. And that's to meet the Paris Agreement, to keep the globe well below 2 degrees Celsius. So to do that, we have to cut emissions by a net 60% by 2050 to avert the worst of ecological collapse, economic collapse, and social collapse. To do that requires capital. So we know from the IPCC that between 1.6 and 3.8 trillion US dollars are needed globally annually to meet the Paris Agreement. And this is a line showing the trends in terms of finance flows, public and private, towards climate solutions from 2012 up until roughly 2017, 2018. So where is the capital? We have a gap. We have in this diagram, we see that we have about 500 billion flowing to climate solutions, and we need trillions. So where is the capital, and how can we get it flowing at a bigger scale, accelerated, to meet the Paris Agreement, to keep the Earth well below 2 degrees Celsius? So here is how we organize the capital in the world. These are global capital stocks. These are not flows. And we organize the capital along a risk tolerance spectrum and a capital intensity spectrum, so a deal size spectrum for capital intensity. And so you see that towards the right, the most risk tolerant of capital, venture capital, for lack of a better word, is also the most, or least it's short supply, in the most short supply, and it's the least available. So we have just over 200 billion US dollars flowing to, or available in terms of high risk venture capital. And also the deal sizes are a bit smaller. Then we have private equity, moving on the risk spectrum. And then we have the public finance world that kind of sometimes acts more commercially, and that's the multilateral development banks and the development financial institutions. And then finally, you have the two biggest pools of capital. One, the asset owners and managers, primarily the mutual funds, insurance companies, and pension funds. They make up the bulk of managed assets globally. And then finally, we have bank deposits. Now, if we're going to illustrate bank assets, that would be the biggest bubble on this graph. Bank assets are by far the biggest pool of capital we have. Here, we're trying not to double count, so we chose the deposits as opposed to the assets of banks. Important to note that over 80% of capital does not cross any border. The minute you cross any kind of national border, the transaction is viewed as risky, right? So you have currency risk, political risk, all kinds of things that make investors hesitant to invest across the border. Needless to say that this is important so we understand, well, what is available? The good news here is that the capital is there. We only need 1 to 2 trillion at the minimum. So we know that it's there in very large supply across our global capital stock. The bad news is that there are barriers to this capital, and I don't have time to go into the details of this. We position these barriers from a project perspective to a portfolio perspective. So some barriers present themselves more at the portfolio level, if you're managing like a portfolio of mortgages, for example, versus the project level, if you are, for example, financing that one particular energy generation project. And so these are the various barriers: pricing of perceived risk, limited sources of that high risk capital that I mentioned, policy uncertainty, lack of transparent data. Often the data is behind paywalls, and even that can be low quality. Deal size preferences, timing of climate impact risks, although I think now we're starting to see an uptick in climate events. Short-term investor horizons, and lack of climate-friendly investment guidelines. Well, I'll summarize all of this by saying inertia, right? The system is not built on a low carbon society, and there's inertia in the system. To do something differently requires an extra effort on behalf of all the investors and lenders out there. We also looked at the who of capital allocation. So in private investing, who actually owns the decision to move towards a greener future, to invest and to lend more and more for climate solutions and less towards those carbon intensive activities. And so this is a pyramid illustrating this ecosystem where you have consumers. So everyone on this call, everyone listening, we all have bank accounts. We all have some kind of savings. A lot of us have retirement funds and other investments. All of that can be aligned with Paris or not. So we all have power to instruct our capital to align in that manner. Small and medium-sized enterprises. We're learning with COVID just how important this is. Small companies make up the bulk of a lot of economies across the globe and make up the bulk of a lot of businesses. They also have agency over their capital, which can be aligned with a low carbon future. Likewise, large businesses, so large non-financial businesses, I should say. Think about all the industries out there that are not financial services. They also have a balance sheet. They have investments. They determine often retirement benefits for employees, which can be aligned with a low carbon future. And then finally, at the very top, we have the corporate financial institutions themselves, or FIs as we call them. And they, of course, are the banks and asset managers, and they can also align their services, their products, their offering for their clients with Paris. And so we should not neglect the role of government in all of this. We have this blue circle around the pyramid, which represents government oversight. So government is supposed to be regulating the entire system, and that can be regulated towards green, away from the carbon intensive. So this is our mission. In a nutshell, we have two pillars. So from consumers to corporate financial institutions, we seek to activate climate solutions through innovative finance and the systemic decarbonization of capital. So those are the two things, the innovative side, and that's to prove to the market that something is financeable, investable, bankable. And the second is systemic. So how do we embed carbon in our decision-making for financial transactions? So I'll give you examples of both. One on the innovative finance side. These are three examples that we have done, also along this risk tolerance capital intensity spectrum, so you get an idea of how this plays out. So on the very risk tolerant venture side, we have invested in the Prime Impact Fund, and they will invest in startups that have solutions that will mitigate or offset at least 1 gigaton of carbon dioxide equivalent annually when the solution is at scale. And so this impact fund is really going out there and seeking not a sector-based approach, but an emissions-based approach. Can this solution in the economy offset or mitigate, the gigaton scale that we're looking for? And these are high-risk interventions, solutions. Think about direct air capture. Think about what we need in agriculture and our soils. Think about all the hard to decarbonize sectors like steel and cement, things that are naturally not going to be attractive for the pension funds and insurance companies and banks at this stage because they're just too early in their development. The next, we have an example of asset management and private equity combined, climate finance partnership. This is a blended finance vehicle. So BlackRock is the largest private asset manager globally. We have two DFIs, IFD in France and KfW in Germany, and also philanthropic funding through the Hewlett Foundation and the Grantham Foundation, and others are coming on board. And so what we're doing is we have layers of concessional capital so that we can attract the private asset manager into investing in both emerging economies and climate solutions. So the goal of this facility or fund is going to invest in an equity fashion in emerging economies and climate solutions, including across energy efficiency in buildings, transportation, zero emissions transportation, and clean energy, renewable energy and storage. And we have a 25% carve out for Africa in this fund as well. So that's to move that asset management private equity side. Finally, as an example on the banking side, so banking, as I mentioned, is the most important pool of capital when you think about what's available globally. Most capital, 90%, is available in terms of bank debt and loans. So we have, in the United States, there's a system of banking cooperatives, and they're called credit unions. And we have invested in a new credit union called the Clean Energy Credit Union. And they do loans exclusively for the clean energy economy. So think about ground source heat pumps, air source heat pumps, energy efficiency equipment, solar, all of that, they're specialized. And there are over 5,000 credit unions in the US. And they are not only doing this type of lending themselves, but they're showing the other credit unions, their peers, how to do this lending through loan participations and through training. There's a network called Inclusive, without the E on the end, their credit union network of community development credit unions. So credit unions that are very targeted in low and middle income communities. We're also working with this network of credit unions to scale the model of clean energy lending or clean energy loans for everyone. So that's an example of the innovative finance side. Systemic decarb, as I call it, we can really think about it in two ways. One is what industry can do for the system, and the other is how government can drive that for the system. And so two examples here. We've supported an initiative called the Partnership for Carbon Accounting Financials, or PCAF. And there's, 5 trillion or more of assets under management under this partnership right now and growing. This is a global initiative. So there are regional committees across the globe for Latin America, for North America, for Sub-Saharan Africa, for North Africa and the Middle East, for Europe, for Asia, you name it. There's a committee of banks and asset managers that are coming together to measure and disclose not the carbon intensity of, let's say, their bank branches, but of their actual core business, which is the finance. So they're measuring and disclosing the carbon emissions of the loans and investments they make. And they're agreeing to decrease that year on year to meet the Paris Agreement. So that's an example of industry organizing for systemic decarbonization. At the same time, we are also working on or funding those that can inform regulatory change. So when it comes to the various alphabet soups of regulatory bodies in the United States, in Europe, and China, those are the 3 markets we work across in terms of what the different agencies can do to incentivize green finance and illustrate the full cost of the pollution associated with carbon, the full economic cost of the carbon. And so there are a number of things under this tent. I also don't have time to go into all of the initiatives and levers, but you could think about from a central bank perspective, there being, for example, for lending, for interest rates, a green premium. So if you are lending for clean energy or high-speed rail, things of that nature, there's a premium on that rate if you're a bank than otherwise. You can also think about account switching. So can consumers easily align their capital with these sustainable banks, like B Corp certified banks or benefit corporations, like GABV Bank? So GABV, GABV, is the Global Alliance for Banking on Values. And the banks that are a part of that network have agreed to not only financial returns, but also social and environmental returns. So can you enable consumers to easily switch? Now, in the UK, they have implemented a process called a current account switch guarantee, which just enables, within a click of a button, individuals and businesses to switch accounts, very seamlessly. So that's something that the government can do to help. And there's everything else in between, including mandating, for example, the measurement and disclosure of carbon emissions from the financial sector. So I don't know if I have time now for Q&A, but happy to take any questions.
Yes, yes, there are going to be questions, and Jorge is going to lead on that, because I think it's important we ask you the questions based on the presentation you've made.
Yes, so thank you very much for this presentation. It's very useful to have this perspective. And as you mentioned, trillions of dollars worth of investment are required to make the system transformations to reduce emissions according to the IPCC scenarios. And there are also trillions of dollars worth of capital at risk of becoming stranded assets. So are there enough projects and proposals waiting for financing that are ready or mature or attractive enough to make different types of investors move from these brown investments or capital assets, and are we moving fast enough from this kind of investments into greener options? And if not, what can the youth do to accelerate this process?
I'm smiling, Jorge, because you said a bad word. You said brown finance. And we're working very hard to remove that from our vocabulary because we're trying to build an inclusive economy, and we don't want to associate brown or black or anything of color and that nature with something we're trying to get rid of in our world. So we're using dirty finance, we're using gray finance, we're using carbon intensive. So I just wanted to share that with not just you, but the entire community of listeners. So moving from the green to the gray, or from the climate friendly to the carbon intensive. So I think you have to break it down by the solution. So if you think about Project Drawdown, you have 80 solutions to climate change that have been modeled out. And some of those are, I think what you're alluding to is large scale project finance. And some of those are very distributed solutions. So think about an electric vehicle, and that's an auto loan, versus a high-speed rail, which is a large infrastructure project. Well, those are very different kinds of financing required for those projects. So when you ask the question about whether their project's ready to go, well, yes, but the answer is matching the type of intervention to the type of financier. So large, high-speed rail often requires public finance, public intervention, given the payoff schemes and given the kind of massive public benefit. Whereas the auto loan, so getting, if you do have to have a car for whatever reason, getting that person, or that, let's say a fleet of buses in a city, to switch from the internal combustion engine to the electric version of that, you could easily see that being financed by a bank that has an auto loan book. And is used to financing a different type of vehicle, and they could easily finance the EV. So really, you have to match the kind of financing with the kind of financier.
Thank you very much for that answer and for the correction as well. My apologies. And then I think Dolphine will introduce our next speaker, or Maria.
Because we have about 2 minutes to the next speaker, I just wanted to ask a question that we collated from one of the forms we sent out before this session, and one of them is this one: how do we get funding for establishing green entrepreneurship? And this is from Sasmita Paddy from India. And I'd like to direct this question to both Marilyn and Edward, and also maybe rephrase it a little bit and ask the question that there is a lot of, we know from the presentation we have just seen, it appears that there is a lot of funding available. So the question is, how do people position themselves to access funding? Also, given the fact that most of these young people are not really doing large scale projects, but smaller scale projects that aren't like in the millions of dollars.
Marilyn, do you want to go first, or should I? Yeah, I think this is a great question. But again, as I was saying before, is that we are still in a lot of organizations are still in the same mentality of the old kind of banking that used to be done 10 years ago. And therefore, for us to be able to get more financing to the young people and for climate change, I think it is interesting that we should set up vehicles which are specifically for that purpose. And the kind of funding of those vehicles should also be high risk, quite a long period of time that we expect to get a return. And it also should be kind of not asking for things like collateral. Of course, this is not the traditional financing. And the truth of the matter is that we just need to encourage more development partners, more people, more foundations to be able to spare money, which then can be able to be put in a fund, which is even more riskier than what we have already, impact funding and things like that. And that way, then we can be able to avail the financing to many people. Because unfortunately, in India, in Kenya, in Tanzania, if you try to go to a bank on green entrepreneurship, you'll not be able to source the funding. We need a special vehicle for that purpose.
Marilyn, I think you're muted. We can't hear you. There you go.
Okay, so the question is green entrepreneurship in India. So there are a number of funds in India that are focused on this, a number of venture capital funds. There's actually quite a vibrant ecosystem in India around so financing for startups. And it depends if your startup is a high growth or more like a small business. So whether, you know, you plan on the nature of your product or service is something that can be scaled rapidly and have that high growth nature. I think I remember that in a previous role, we financed from our venture capital fund, Chinma Networks in India, which was since acquired by a large French multinational company. So depending on the nature of the company, there is an ecosystem in India, a venture capital financiers that are socially responsible, environmentally responsible, and looking for what problem are you solving out there. And if you're solving an environmental problem, for example, if you're solving climate change in a fashion that is perceived as high growth, then there's an ecosystem available. So there's a number of institutions. Also in India, there are a number of non-banking financial corporations. So they're not, they don't take in deposits. So they're not like Yes Bank, for example, in India, but they do lend. They are lending facilities. And there are also a number of these that are specialized in green. They would be less likely to support or finance high growth type of entrepreneurship, but they would be supportive of more, for example, solar businesses that are very established and supporting through lending those types of businesses. So there actually is an ecosystem in India around this.
Thank you, Marilyn, for that presentation and for those answers. I'm sure we have a lot more burning questions, but for the sake of time, I'd like to welcome Miss Athena to share with us what she had prepared for us today and basically give us a brief of how we can use venture philanthropy to accelerate issues of climate action and a clean energy transition. So, Miss Athena, I want to hand over to you.
Okay. Can you guys hear me? I'm going to try and share my screen. Does that work?
Yes.
All right. Good morning again. Good afternoon. Good evening, everybody. I thought I'll share some of our thinking, and not just from my foundation, but together with a network of foundations, including Hewlett, of course, which is one of our biggest and major partners. And Marilyn has presented a lot of the work that they're doing in that space. To really share two examples of how we think foundations like ours, a venture philanthropy fund, can help unlock climate financing, both from the private sector and particularly from climate finance donor governments who have committed to delivering climate financing at scale under the UN Framework Convention on Climate Change, and specifically under the Paris Agreement. So I think the first speaker, Edward, hinted to the role of venture philanthropy. As I said, we are a venture philanthropy founded about 14 years ago as part of the Rockefeller group of family foundations. And we deliberately are mission-oriented around climate action, and particularly enabling civil society participation to be part of that clean energy transition that you guys have talked about earlier. I think the two main differences between traditional philanthropy and venture philanthropy is the fact that we consider ourselves, as Marilyn hinted earlier, sort of the angels in the philanthropic space. So we're very, very adventurous and pretty high risk and not afraid to fail. Because I think as John Rockefeller in 1969 defined venture philanthropy, he said these are foundations that are willing to be adventurous and risky and fund unpopular and unconventional social and environmental causes. So based on that, we work with a network of other venture philanthropists around the world, but particularly in the US. And traditionally, our philanthropy, together with partners, have funded organizations and think tanks, primarily in Asia, in the US and Europe. We just started doing grants in Africa on the policy space. So we think, as previous speakers have alluded to, public policy and enabling conditions for clean energy and sustainable infrastructure to thrive really need to be at the front and center of any decision making. Otherwise, some of the alternatives that we are talking about will not be able to compete with some of the fossil fuel and carbon intensive options that are there. We in particular are on the lookout for funding Global South think tanks and policy research organizations and movements, particularly those organizations that are led by women and young women, because we think young people, particularly women-led entrepreneurs, Southern women-led civil society organizations will be so critical, are critical, but will even be more critical in future decision-making for climate-friendly investments. As a venture philanthropy, we also are in a really good place to be the risky first stage, early stage investor when either the private sector or government funders are reluctant to take risks. And so we have started over the last 4 or 5 years, especially as I was recovering from being a climate finance practitioner, trying to think about innovative ways where our philanthropic capital can help unlock both public sector and private sector money. We also do support business and industry voices, particularly clean energy industry voices from the Global South, especially now in response to COVID and governments responding to COVID. We want to make sure that the voices of entrepreneurs and the clean energy industry is heard as loudly and equally as they are hearing from the coal and the gas industry. So that's just sort of a snapshot of what we as a philanthropic foundation do on policy, on building the field, and on catalyzing innovation. So let me just briefly share 2 examples, which we are not only doing, but we're doing with a coalition of partners on how we are fostering innovation in climate finance, and also de-risking and providing early stage capital, which Edward mentioned earlier. So the first example I want to give is from the region where I come from. I'm from the Philippines, so I care so much about the impact of climate change now and the devastating impacts of climate change on the economies of the Philippines and of many of the Southeast Asian countries. And as you know, just like many countries in Africa, many Southeast Asian countries are vulnerable to the impacts of climate change. Many of our countries rank, sadly, at the highest of any global climate risk indices. In fact, the Philippines is usually in the top 3 or 4 or 5 because of the number of devastating typhoons and extreme weather events, which make the country so vulnerable and economically very unstable. Also, the population growth in Southeast Asia, as you know, is quite significant and has a huge impact in consumption and energy intensity. The region is so rich in renewable energy and endowed with a lot of clean energy resources. Indonesia and the Philippines alone are the top 2 geothermal capitals of the world. There's massive utility scale wind and solar and biomass across the region. Yet, this is the problem. If you are following the energy conversations in our country, especially now, even amidst COVID, there is a very strong push to rely on traditional carbon-intensive projects, despite the fact that they have been proven to be uneconomical and non-competitive compared to new energy technologies. Between Vietnam, Indonesia, and the Philippines alone, I think there is a planned 70 gigawatts of coal in the next 10 to 15 years, which completely undermine any of the commitments under Paris. And so, as Marilyn said earlier, if we really want to stay below well 2 degrees or aspirationally 1.5, most of the countries in the world need to decarbonize by 2050. And in order to get to that place, most of our countries should be striving to get away from these carbon-intensive technologies and leapfrog into a clean energy future. So what have we done? And this is probably one of my favorite projects since I made the leap from being a think tank and climate finance practitioner to being part of philanthropy is we started forging a partnership between philanthropic foundations, and there's about 12 of us that's part of this partnership. It's called the Southeast Asia Energy Transition Partnership, and we have the Rockefeller Foundation, the Royal Family Fund, Hewlett, Bloomberg, IKEA Foundation, the Children's Investment Fund, and a few other major climate and energy foundations, partnering with 5 major climate finance donor governments led by the UK, Germany, Canada, Denmark, and France. And the idea really is to forge a collaboration between philanthropy and climate finance donors to help unlock both development cooperation, basically aid, a lot of bilateral investments, but particularly climate financing from multilateral institutions and the private sector. So this partnership has gone live last year during the UN General Assembly Summit. And towards the end of the year, we'll actually start operating under UNOPS in Bangkok, and we will start disbursing money. So there are 3 aspects to this partnership, which I think probably already exist in Africa. One is we do have a civil society grant-making facility. So we do fund organizations from Southeast Asia. We're doing policy work, regulatory work, campaigning, communications. We do fund youth movements in Southeast Asia who are pushing for policy changes in government. And then this partnership in particular is focused on the second window, which is technical assistance, where we could provide technical assistance to governments, to think tanks, economic advisors who would like to work with government to achieve some of their renewable energy targets. And then the third part of this partnership is the one that relates most to this conversation, which is a Southeast Asia clean energy facility, very similar to some of the mechanisms that Marilyn talked about earlier in terms of filling that gap. So the idea behind this clean energy facility, which I'm sure has the equivalent in Africa and Latin America, is to really fill this gap of catalytic early stage project development capital. So we find that in most countries in Southeast Asia, they have very ambitious renewable energy targets, and they're contained in their NDCs, right? The nationally determined contributions. But most of the targets are just sitting there. So, for example, the Philippines wants to leapfrog into 100% renewable energy future, but the government still relies on coal and wants to build more coal plants in the next 10 years, whereas we have massive utility scale wind and solar and biomass. But the developers are facing really serious issues around getting money for their wind resource assessments, project development to make the project proposals bankable and competitive. So this is really what this facility is about. And I think the nice thing is about $10 million worth of foundation and philanthropic money is going into this fund to help unlock more money coming from the private sector. And so to me, this is an innovation where philanthropic foundations are not only funding one part of the problem, but we are trying to fund and support together with government partners and the private sector, the ecosystem of stakeholders that could really make and fill in the gaps in the overall climate finance landscape. So as I said, some of us are funding the policy and advocacy and communications work. that will generate the demand from the countries and from the consumers and citizens for cleaner energy options. And some foundations will put and pull money to form a clean energy facility, such as the CSEF, or the Southeast Asia Clean Energy Facility. And some foundations like Hewlett and Grantham Foundation and others will get engaged in larger blended finance facilities. So from my perspective, having been a climate finance negotiator and a climate finance practitioner, this is an innovation in the sense that we are trying to work together rather than be siloed in our own worlds, so that we could help fill in the gaps and see some transformational outcomes in some of these key markets. So finally, a related example is something also pretty exciting. And this is an initiative that's led by the V20. If you don't know what the V20 is, it's the intergovernmental coalition of all the finance ministers of the most vulnerable countries. So this is a sister coalition to the Climate Vulnerable Forum, which has been a very progressive coalition of countries that have pushed for ambitious targets in the lead up to Paris, and are now really talking about sustainable, just, and equitable recovery after COVID. The current chair is Bangladesh. And so in their conversations, one of the challenges that vulnerable country finance ministers face is, even if they want to embark on a low carbon future, they are faced with so many risks, technical risks, financial constraints, and most especially regulatory constraints. Because again, most of our economies, particularly in Asia, are so used to relying on carbon-intensive sources, and our policy and regulatory environment is not ready or not yet built fully for a sustainable clean energy system. So one innovative financing mechanism that has come directly from the finance ministers of the vulnerable countries is a concept called an accelerated financing mechanism. And it's not very different from any of the de-risking and early stage mechanisms presented earlier. But this is specifically to help the most vulnerable countries leapfrog into that safe and sustainable future by combining initially a target of 500 million from philanthropy, from private sector, even from the Green Climate Fund, with 500 million from an EU blended finance facility, together with a small project development facility to help address some of the project preparatory stage. So this is a very nascent concept, but has already been championed by the Troika. The leaders are Bangladesh, Costa Rica, Ethiopia. I heard Kenya is really interested in this mechanism. And again, this is a really good way to think about how our ecosystem of experts and how the different suppliers of money and finance can work together, and figuring out how philanthropy can help that ecosystem meet some of the climate financing gaps. So I'll stop there. Thank you.
Thank you very much for that very vivid explanation. Just a brief point, because it's been quite a lot of information that you've given us. Just one bit of question. In your experience, in line with the recent state of negotiations on climate finance, we've seen there's a drag in mobilizing of resources. In your experience as a negotiator, in your work with the WRI, and until now, do you think we are headed anywhere towards meeting the 20? It's supposed to be 100 billion gap in issues of climate financing, and do you think the private sector will be key in basically filling up this gap? Yes.
Yeah, I think that's actually a really good question for Stacy to answer as well. Putting on my climate finance negotiating hat, and just based on current methodologies and the reporting that's been coming to us, I still do a lot of technical work in following the money and following both the public finance commitments from governments and some of the aligned funding from private sector and multilateral institutions. We're nowhere near the target, honestly, right? And just with current methodology, public financing in particular is limited, especially now for really understandable reasons. But not to state the obvious, the biggest source and the potentially biggest contributor to climate finance in the negotiations is not on the table. So I think it is very, very difficult to imagine how we're gonna meet that target. And so I think maybe Stacy is gonna touch on this. I think one of the things we really have to do is, first of all, to maintain the political momentum towards the COP in Glasgow, which is now postponed to 2021. There is a lot of opportunity to do blended financing, to look at how catalytic financing from philanthropy and other grant-making bodies can unlock private sector investments. But most importantly, many of the governments have very ambitious climate finance targets in their own national plans, and they are committing their domestic capital, however limited that is. So I think we have to be a little bit more creative and innovative outside of the traditional UNFCCC mantra, to say this is about a race to the top. This is about increasing climate ambition. And if countries have bold ambition and they say, we're going to put our money on the table, but this is the amount of money that we would need from the international community, and then we can scale up our targets on renewable energy, on meeting Kigali and Paris, on sustainable transport that Marilyn alluded to, then I think it's a healthier conversation rather than keeping on demanding a certain amount of money from certain countries, which could take forever. I mean, it's still their historical responsibility. They will have to deliver on that. But one of my personal reflections in this space is that at some point, we have to share that ambition. And we have to share that responsibility, and it has to be incentives-based. So the higher and more ambitious your targets are, the better it is and the more money will flow, hopefully.
Thank you very much for that. And I think you mentioned, I think Kenya as a country is looking to borrow some of your models. I think for us as a country, I think it just came out today. The Kenya as a country has gone ahead to try and basically code and track these resources that are coming to address issues of climate change, because initially we've only been able to track the finances that come via the government. But for the other key players like the civil society, the private sector, it has not been able to actually track it, but it is now when the country is setting. I think with that, I think we would also, in addition to what you said, we were actually headed in the right direction. I think I'll hand over to Jorge to introduce the next speaker.
Okay, there's a small question follow up on this very interesting presentation. I'm not sure if you could elaborate a little bit more on how far can philanthropic capital take us on the risking, and also if you could tell us a little bit more about how youth could seek or access this capital for their projects and initiatives around the world.
I can weigh in, and Marilyn, you should also jump in, because this is exactly what Hewlett is doing. In one or two of the partnerships that we're in, the best way to engage is through country or regional specific initiatives. So in our case, for the Southeast Asia Energy Transition Partnership, we have set very clear and ambitious goals. We are really trying to disrupt this coal surge in the region. And if we want to do that, we will have to unlock Southeast Asia entrepreneurs and project developers partnering with the international community to invest massively, not just in utility scale renewable energy to meet the growing demand, but also electrify the islands, which, as you know, is 60-70% dependent on diesel, which is 3 times more expensive than many of the renewable energy technologies. So the best way to engage is to and access not just the resources, but the technical assistance, support, and tools and frameworks, and a lot of the trainings is through those regional platforms. There are partners in our philanthropic platform who have opened up very specific windows also for entrepreneurs. So IKEA Foundation, unfortunately they're not here, but maybe you can invite them next time. They have a huge program in India and in Indonesia in particular, and they support groups like New Energy Nexus, whose job is to help seed and incubate accelerators. It's exactly what Kenya, I call them Kenya Kick, because I like the acronym. Kenya Kick is doing, empowering local regionally based entrepreneurs to be part of that clean energy economy conversation. And there are resources available for that. So the more local and place-based you are, actually the better it is to access these resources.
Thank you very much for your answer. I'm not sure if Marilyn would like to jump in or if I should introduce our next speaker. Marilyn? Okay, so then I would like to introduce Stacy Swann, CEO and founding partner of ClimFinance Advisors. She will be telling us about blended finance and leveraging private and public investment in the wake of climate risk. So Stacy, the floor is yours. Thank you for being with us.
Hi, everybody. So thank you for having me. Can you hear me? Everybody can hear me?
Yes.
Great. Yes. I'm going to try and share my screen. So let's see how this works. Okay. All right. Let's see if that one share. Can you see my screen?
Yes.
Yes. Okay. All right. So first of all, I want to say thank you very much for including me in this panel presentation, this webinar. It's really a delight to be talking to you all today. And I was struck by how the conversation was unfolding. I felt like we could have a number of different types of presentations here, but I have a few slides that I will go through, and then I'll kind of come back to some of the themes that that the presenters have already touched upon. So first of all, a little bit about ClimFinance Advisors. We are 5 years old. We were established in 2015, and we are women-owned small business in Washington. We're also a benefit LLC. And our boutique consulting firm works at the nexus of private sector investment and climate change. But our core skill sets include blended finance, climate finance, and really how to get finance flowing to address the climate crisis, both on the adaptation side and the mitigation side. We are a collection of practitioners. We come from banking, development finance, private equity, and collectively we like to say that we bring, you know, the experience of how to structure and put together different types of financing to address certain problems. And that is true at the very small level for venture capital, impact investing, some philanthropic investing, but also at a very big ticket size level. Some investors call, you know, big infrastructure, big ticket size, you know, big commercial financing. We also have that experience. As a firm, we advise not only investors on the private side, but we also advise public investors, DFIs, but also governments and policymakers, and in particular on really how to kind of action policies that would address climate change and finance. So we like to think of ourselves as not theoretical practitioners, but actually helping policymakers and governments and DFIs to really ground and execute some of their ideas on how to catalyze climate investment. This brings us into the financial policy space a lot, and some of my slides here are going to start out talking about financial policy, in part because of the moment that we're in the COVID crisis. The moment that we're in time, we are in 2020, and we ought to have gotten farther than we have gotten to address the climate challenge today. And that means that from here on out, we need to really step up our action and accelerate what we do. And we definitely work increasingly around the question of climate risk and how that interacts with applying finance, and I'll come back to that in a minute when I talk about blended finance. So I'll skip over this. These are our 4 business lines. Those of you who know us, we work on, you know, both policy level things, but also practical applications on how to put funds together, facilities together, blended finance vehicles, We help appraise and structure climate smart investments. We help investors develop climate smart strategies. And we do a lot of work around climate risk in the financial system and financial products and services. But all of this is underpinned by a core part of our mission, which is that we believe that how we invest matters, and that every dollar, regardless of whether it's tied to a political objective or not, should be clean, green, and resilient. I'll start with an optimistic slide. We have a lot to be pessimistic about on the climate agenda, but a little bit of optimism. We do see investor sentiment and awareness changing, and we see it changing fast. So obviously 2015 and the Paris Agreement changed the climate finance landscape, and that brought a certain level of awareness and focus on the international scale. There have been challenges for implementing that for sure. But in the let's say non-international political realm, we are also seeing the awareness of climate as an issue really grow among everyday investors. 5 years ago in the private sector and with private finance, we were really hearing a number of investors scratch their head and say, this is really, it's far off, it's abstract, maybe the regulation is too political, it's a risk, but it's not important. Investors were kind of crowding around it, but most of those investors who were crowding around it 5, 7, 10 years ago were impact investors and investors with a social mission. One big question that we used to get not too long ago was, well, this is just more costly to address this than, business as usual. That, in our view, has changed significantly, and there's a number of reasons why. A lot of people talk about the Task Force on Climate-Related Financial Disclosures as raising awareness within the financial sector. Yes, I think that's true. I also think that today climate change is more readily observable to everybody, and it's becoming broadly accepted by those in the financial sector. And in parallel with TCFD, the Paris Agreement, and a number of the initiatives that have been happening around the financial policy space, there's more robust regulatory schemes that are being discussed. And investors really do see this as a prominent risk that they need to get their hands around. They haven't quite figured out how to get their hands around it, but there's a lot of momentum in this space to really help them do this. As a risk also, I think a number of investors are seeing, let's say, the silver lining of risk management being a greater opportunity set. So somebody on the webinar today talked about pipeline and projects, and I do believe that we will turn the corner at some point soon where you'll start to see innovators, entrepreneurs, and really forward-leading investors starting to think about the opportunity set from being more resilient and climate friendly. That's coming very quickly. But in any case, in the context of the changes that have been happening, what you're seeing in the last couple of years, and particularly since the Task Force on Climate-Related Financial Disclosures, is a significant effort to address climate risks at a policy level and at an institution level. And when I say institution, I mean financial institutions, but I mean financial institutions of all types. And we've been talking a little bit about different types of financial institutions on this webinar, and I want to just note that it's really important to understand that there is a financial ecosystem of different types of financial actors, and they work in different ways, and they have different risk appetites, and they engage in the markets in different ways. And I'm sorry, I was searching for a slide to put in here on that, but I don't have it today. But if I had a whiteboard, I would draw it out for you. But anyway, the point is that we do see a level of awareness at the institution level, which is really good, because that will help us ensure that financing flows in a more green and resilient way. So if that prior slide was the optimistic slide, this slide is maybe the less optimistic slide. Some of the more practical drivers are based in the fact that we've locked in enough warming and that warming is observable. And that warming has impacts, both acute and chronic, and those impacts have financial consequences. I don't know if you can see I don't know whether you guys are able to see this. Can you see that?
Yes.
Yes, we can see it.
Yes.
Great. Wonderful. Okay. Obviously, these financial impacts have economic implications, but they potentially have implications for capital flight in some countries and in some regions, political instability. And this underpins what has been happening over the last 15 years in terms of accelerating income inequality and really the gap between what is the financial markets, when in quotes, the financial markets, listed equities, the Goldman Sachs's of the world, and everyday Main Street. And this is a very important issue because it impacts vulnerable communities. It has the potential to accelerate or exacerbate vulnerability. But it also puts greater pressure on the public balance sheet, regardless of where you are. So whether it's the state and local public balance sheet, the municipal balance sheet, a country's balance sheet, it really does mean that the public balance sheet has a bit more pressure to address some of these issues at the very same time that we've been talking about how to take public money and catalyze private capital. And this is a pretty important message because when the public balance sheet is stressed, it has less room to do that catalyzing. And when the private capital flees, if there is capital flight from vulnerable communities, it has the potential to catalyze less. And this is a challenge that needs to be addressed head on. This has implications for development, economic growth, and of course, income inequality. However, if you're very clear-headed and mindful about this from the policy side, you can design well. You can implement well-designed public financing approaches that can incentivize and catalyze and accelerate solutions to address the mitigation side and enable communities to adapt to already locked-in warming. This means that you're going to have very difficult conversations about where to put that money. It means it might be more bang for buck in terms of the development impact or just a general kind of public good impact to put your public money and your public financing towards things that help the vulnerable communities over things that might, let's say, attract market-based capital, even if that market-based capital says we must have some risk coverage in order to come into your infrastructure project or your municipal lending, for example. However, as I mentioned earlier, time is not on our side. We're at 2020 and we still have a long way to go to catalyze the financing that's needed to address climate change. And so the more time that goes on, the more difficult the decisions on the horizon will be in terms of how to allocate financing. And one example of this is water infrastructure. This is one of those areas where you could kind of ground this and say, do you want to invest in water infrastructure because of the essential services and public nature of that? And how do you do that in a way that addresses vulnerable communities, that crowds in capital, and enables you to increase resilience and address climate change? These are all kind of things that you would talk about when thinking about, from the public balance sheet side, how to allocate your capital towards climate. We've talked a little bit about this, what happens with a better understanding of risks. So if today the level of climate awareness among investors is much higher than it was 5 years ago, you do have, on the positive side, a tilting and a shift towards climate resilient assets. That's just starting, but I see that accelerating in the next couple of years, and also new business models and opportunities. And so for those of you who are in innovation labs and innovation hubs and working with entrepreneurs, this is a real opportunity to really pull together the Venn diagram of climate resilience and accelerate new business models and opportunities. And that is countered by this question of capital shift or flight. This is a slide that we put together well before COVID. I think the COVID experience shows us that this is true. When you look at the numbers in terms of capital flight, particularly out of emerging markets, it's been dramatic since March. We have a lot of work to do. However, in the context of the green stimulus, or in my view, any stimulus which should be sustainable and resilient, we should be addressing this front and center. So I'm going to go through very quickly just a little bit of a schematic to get to the point of how do you get finance and blended finance flowing. This is really a very wonky slide around financial system governance bodies, but it's partly to talk about the role of policymakers and policy making when it comes to climate change and climate risk, and just to show that not all financial policy making actually focuses on getting the finance flowing, and a lot of it focuses on the enabling environment, like standard setting, like disclosure and reporting, like stress testing. You can't manage a financial system unless you're stress testing and looking at the systemic risks. But most fiscal and monetary policy does have, and has had forever, the ability to provide incentives, financial incentives, either tax incentives or other kinds of, let's say, public balance sheet financial incentives that can catalyze private investment around these issues. So this is really just to kind of explain that there's a lot of different levers at play when people talk about the policy side and the policy making side when it comes to catalyzing climate. This is another way of showing that, and again, just showing you that the incentives, I don't know if you can see my mouse here, the incentives that you might pull together on the public balance sheet are really one of many different things that would have to happen to enable the whole financial system and the policymaking apparatus to align around clean and green. And one of the reasons why I wanted to put this up is because there's a lot of discussion around TCFD, and it's very important, but it's not the only thing that needs to happen. So how does climate change impact investors and investment? Obviously, in my next couple of slides are going to talk about infrastructure because it's a tangible example, but in my remarks, I'll talk a little bit about blended finance approaches and also the financial ecosystem. So for illustration, obviously the impacts on infrastructure, there's business interruption, there's physical damages from physical impacts from climate change, performance of operations. This is pretty important when investors are looking at appraising a project or a company to invest in. You want to make sure that you're being mindful of how your operations might change from impacts from climate change, either acute or chronic. Energy performance is a good example of that. Your supply chains, your availability of resources and raw materials, and then importantly, your change in demand for products and services. How is that affected by some of the expected impacts from climate change, both acute and chronic? And this flows through, this is the financial implications on your revenue, costs, your capital expenditures directly, but it also may have an indirect impact on your valuation and your creditworthiness. And these are important metrics for any investor, regardless of the investor and where they're coming in. And then the instruments that they use, whether they're providing you loans or they're providing you equity, the effects of the physical and transition risks can flow through into how your financing is structured and what impacts it has on you. So this is a very busy slide, but as the conversation was unfolding earlier, I really thought it was important maybe to pull this one out. So let me go to the next one and then I'll go back. So we did some work for the World Economic Forum last year, building from their blended finance task force. And their blended finance task force has 4 steps, starting at preparing, pioneering, anchoring, anchoring, and transitioning. So those 4 steps are preparing, pioneering, anchoring, and transitioning, those colored steps. And within each of those steps, there's it aligns with different parts of a project's life cycle and a market's life cycle. So if you think of the preparing part of the life cycle, Here you're talking about entrepreneurs, innovative solutions which may not yet be commercial. In the pioneering, you're maybe kind of past the early stage seed part of a project and you're getting into the venture capital part of the project. At the next stage, you're scaling up and you're trying to kind of build and grow your company or your project. And then at the mature stage of the market and the mature stage of companies, these are companies which are fully commercially viable and really kind of can attract commercial financing. The work that we did for WEF and building from the Blended Finance Task Force added 2 prior steps to this, really to capture the climate finance landscape connections with NDCs and country strategies. And what we were trying to articulate here is that countries and in the country planning and in the policy stages really do need to think strategically about how they're allocating their public balance sheets. And this is pretty important because you can take public financing is not endless, which is why we've had years and years of discussion around taking that balance sheet and leveraging private capital. But you need to be strategic about it, and you need to think, okay, what are the types of things that I as a government or I as as an owner of the public balance sheet, whether it's the country level or even the municipal level, where do I want to allocate my scarce resources? And in that sorting process, some things will never be commercially viable. Some things will be things that you need to fund because it's part of the public good and it doesn't have a revenue stream that can be commercially viable. There are other things on the other end of the spectrum which have the potential to be fully commercially viable, and you may want to privatize that or have that be completely spun out into the private sector to take care of. And then there's a bunch of stuff in between. These often in infrastructure, these are PPPs, but it's also this innovative space and this innovation space that is a little bit of a hybrid where public capital, a little bit of public capital, or development finance capital or patient capital can really catalyze these companies through this life cycle, through the development, the market making, through the building stage into the growth stage, and that's really important. So I wanted to put this up there just given where the conversation had been going, and I'll go back now to talk about the blended finance role. So we call this the public sector role for this work that we did for the World Economic Forum, but really it's any pot of capital or source of capital that has the ability to take greater risks for the impacts or the public good it's seeking to catalyze. So in this second layer here, you'll see what the role is of some of these funds. So these funds can fund upfront costs of activities, reducing uncertainty, build a pipeline of bankable projects. And that's really in kind of more the strategic and how do you kind of come up with a pipeline of projects for a market. In the pioneering and facilitating role, public and patient and blended and concessional capital really is meant to take a higher risk or provide low cost financing in order to underpin the work that needs to be done to build the company, to build the entity, to build the activity, and also demonstrate to the markets the viability of these enterprises. At the anchoring stage, blended finance and public sector finance really tends to be more of a signaling effect, more of a stamp of approval. If you really get down to it and you were talking about companies that had a little bit of a track record, that had gone through, let's say, an incubator, that had gotten seed capital, that had maybe raised Series A capital and was really starting to scale up, you may not need blended finance or public finance or concessional finance, but in certain markets, it may be helpful to really kickstart that. And here, as in everything related to climate, some of your decisions have to do with how quickly do you need to get some of these things done. And so in the anchoring stage, you might have blended finance playing that role. In the transitioning stage, or where mature markets happen, your blended finance really is meant to be used in a very limited way, or it should be. You should have entities, companies, investments that are able to prove their viability on a purely commercial basis. In some cases, blended finance is used in this area, or this kind of mature space. And as Athena would know, many of the DFIs also place blended finance at big projects up here, which may have the potential to stand on their own. But part of the reason why one might do that is really because of other risks in the market that are being addressed. And there's pros and cons to whether climate finance should do that or other finance should do that. But that's where you see a lot of the kind of DFI money in the big infrastructure projects that might otherwise be commercially viable. And then I just wanted to, just because of the conversation and what we were talking about earlier, I just wanted to give a little bit of a landscape to show not all finance is everywhere. And this is a slide that shows infrastructure. We have another slide, I just couldn't find it, that has a more thorough financial ecosystem view. But just to walk you through what this shows, most infrastructure has three general phases. There's preparation, there's construction, and there's operation. You see most of the investors that people talk about in terms of, catalyzing their funding, most of them only play or only invest once a project is fully operational and has a steady stream of revenues. And this is also the stage where you see projects issuing green bonds, and you see a number of these types of investors like pension funds, sovereign wealth funds, institutional investors buying green bonds of an already existing asset. But in the construction phase, you really have infrastructure banks, you have some private equity infrastructure funds, some commercial banks, and the DFIs. And in the preparation phase, there's even fewer sources of capital, mostly DFIs and some grant-based funding. But the project sponsor takes a lot of the costs of preparing an infrastructure project. And this let's say landscape of evolution of how a company grows and what types of funding goes in each bucket is important to recognize, because infrastructure is obviously a big type of investment. But if you thought of, as someone mentioned, the solar cookers, that's going to have its own evolution as a company. And the types of investments that the types of investors that would be it would be looking to attract at each stage of its own growth would be very different, depending on the types of risks that those investors are looking to take. And very much at the early stage, at the preparation stage, at the innovation stage, it's very much a field of philanthropic impact investors, sometimes venture capital, but not always. They're a little further along. And that's a really important thing to understand in terms of the financial ecosystem landscape. And I think I'll stop there and see if there's any questions.
Stacy, you are just getting to the part. So I'm wondering if you could do that in like 2-3 minutes, because that's also really important for us to understand.
Can you say that again? You cut out for a second.
Oh, I was just saying the slide you had last on the climate risks. Maybe if you could do that.
Oh, sure. Sure. Okay, hold on one second. Yep. Okay, can you see that? Okay. So this slide is really about how the climate-related risks, physical transition, and liability risks might translate into financial impacts. So obviously on the physical side, you have chronic hazards, sea level rise, temperature patterns, drought, precipitation, flood, wind, cyclones. Transition risk, you've got policy and legal risks, technology risks, reputation risks and market risks. And liability risks are, legal liability from harm and potentially compensation and reparation. Those are kind of general buckets of climate-related risks, and they all have financial impacts. And those financial impacts are all felt on the balance sheet, the balance sheets of institutions, whether you're a company or a financial institution. So these financial impacts in the first instance can be in the form of physical damage to assets or rising insurance costs, supply chain disruption, changes in inputs, your resource input prices, your production or operation disruptions from power or worker availability, changes in demand for products and services, and then of course increases in legal and compensation costs. And I would say a number of these are also important to note. A number of these have been felt during COVID. So, these are, while we were talking about them as a climate-related risk 6 months ago, we've actually experienced many of them in the context of the economic, the fact that the economic kind of machine itself or the engine itself has really ground to a halt in many ways. And so these are things that, a lot of these systemic disruptions can affect. So.
Hey, thank you very much for such a thorough presentation on these topics. I think in the interest of time, I will introduce our next and last speaker, Chinma George from Team Lead ClimFinance Consulting. The floor is yours.
Yes, thank you very much. Stacy, I must say your presentation was very in-depth, and it'd be nice if you can share it afterwards. Can you hear me, everyone? Yes, I guess so.
Yes. Yes.
Okay. So I'm saying that because I'm working on a project on climate risk in the agricultural sector. So it would be interesting to look at your views on that. So going forward, I was speaking on green bonds. My name is Chinma George. I'm the team lead of in ClimFinance Consulting, and what we do is we're a research think tank. We provide advisory services on climate finance, climate change issues. We've worked with the Nigerian parliamentarians in building their capacity to assess climate finance. I'll make my presentation brief because we've been here for a bit. So basically, to start with, green bonds are fixed debt income instruments used to finance or refinance green projects. Now, green projects, there are a number of green projects are projects that are climate friendly and environmentally friendly, and the green bond principles has lists a number of projects that are green or that can be termed green. So we talk of energy efficiency, we talk of renewable energy, we talk of climate smart agriculture, amongst others. So in the course of my presentation, I will be talking of green bonds as a whole in the global market, and I will narrow it down to Nigeria, that has issued 2 green bonds, 1 sovereign green bonds and twice, and private sector green bonds from a bank, a financial institution. So green bonds mobilize resources from both the domestic and international capital markets for climate change adaptation and mitigation projects. The first time green bonds was issued was by World Bank in collaboration with the European Investment Bank in 2009, and the market has been so good. It's been growing, and as of last year, it had reached a milestone of 200 billion, and that was because of China joining the green bonds market, France, and other stakeholders. Some of the countries that have issued: Germany, Netherlands, Sweden, Spain, Japan, and Italy, amongst others. Now, to narrow down to climate change is a major issue that we're facing in Nigeria, and apart from green bonds used to, apart from investors' appetite moving towards environmental, social, and governance issues. So nowadays, investors are trying to invest in cleaner technologies, are trying to make sure their investment portfolio has a combination of projects that protect the environment, have social impacts, and have governance impacts. And that's why we're seeing a lot of investment moving towards green projects, impact investments too. Green bonds have also been used, or are also being used as a potential to fund both climate national determined contributions by countries to their Paris national determined contributions by countries for their Paris agreement. And Nigeria has raised green bonds to fund her NDCs. So first of all, based on studies by the World Bank, it's been shown that it's going to cost about $142 billion for Nigeria to fund her NDCs, and therefore she has raised two sovereign green bonds, both $10 billion, and one private sector green bond. So if you're looking at Nigerian NDCs, Nigeria intends to add to finance their NDCs 20% conditional and 45% unconditional. And looking at different range of projects, the country is looking at ending gas flaring by 2030, shifting towards upgrade sector, reforestation, climate smart agriculture, moving from car to buses, and having more energy efficiency projects. So now, yes, we've heard of green bonds. Green bonds is now the new innovative way of financing green projects. But how do they work? How can we benefit from them? And how can youth actually benefit from green bonds? Now, the thing with green bonds is that for example, sovereign green bonds, once they're issued, part of the requirements to issue green bonds have that you have to have the use of proceeds. So what the projects that are going to be funded have to be stated during the issuance. So it is based on those projects that the money will go to those projects. And for example, in Nigeria, the sovereign green bonds are only used for federal government projects. So therefore, they have a committee that was set up, an interministerial committee with different ministries and different agencies coming together to look at projects that are necessary for the growth, that are highly impacted by climate change, and then meets the NDCs. And based on that compilation, they listed out a bunch of projects to fund. And some of those projects are going to be refinanced, and some of the projects are going to be financed. They have already started financing some renewable energy projects and some afforestation projects in the country. And so that's for green bonds, but that's for sovereign green bonds. Then for private sector green bonds, which is Access Bank, I think it's easier and open for other individuals to access. So that way people can write depending on the projects they have, but since it's a financial sector and since it's a commercial bank, and in order for it to track the investments and track the funding to make sure it meets requirements, it's required that you open an account with them before you're able to access those funds, and so that the projects can be properly tracked to make sure these funds are used for green projects. So that is just a snapshot of how green bonds work and how it has been adopted in Nigeria, and those are some of the examples that have been used. But now the issue with green bonds now, not necessarily the issue, but one concern we should be looking at when we're talking about green bonds and looking at Nigeria as an example is the risk factor and how there's going to be monitoring, how risk management is going to be assessed, and how there's going to be proper monitoring of the projects to make sure that what is said will be financed is going to be financed, and to prepare for risk. For example, if you're supposed to plant hectares of trees, if you're supposed to plant across hectares, you have to have a risk factor in case you have a disaster or something that is going to destroy the investment. So those are some of the areas that we're looking at, or that should be looked at in Nigeria with regards to green bonds. Thank you very much.
Thank you for this explanation on green bonds and how they could potentially start changing things from the federal perspective as well. And I think we have some general questions that many of you can jump in and answer if you want. or you have something to add. And I think the first question that I want to ask for all our panelists is not just one specific case, but in general, how can we avoid, or how can we deal with greenwashing or investments that do not necessarily advocate for a green economy and are an attempt to cover up dirty money from old companies and the like? This could be applicable for green bonds. It could be applicable as well for venture philanthropy. I don't know if any one of you wants to answer how to actually make sure this investment goes for transformational and green investments.
Okay, so let me just comment briefly. There are different types of green bonds, and for example, one type of green bonds is use of proceeds green bonds. Therefore, also there are guiding rules, voluntary guiding principles and rules for the green bond market. So we have green bond principles, and it shows one of the major things that are enforced is accountability and transparency. So investors are able to track that the projects are actually green. But there have been issues and there have been concerns about greenwash, even in green bonds, and how are we sure that some of these funds goes to green projects? And that has been a concern, and I think that can be pegged from the type of green bond that is raised. So some bonds, some type of bonds are not necessarily only factored to towards environmental friendly. And we have been seeing that even in the global climate finance market and architecture, that funding has been moved towards projects that are not so clean and not so green. And that's an issue that is being seen globally now.
Thank you. Does anybody else have anything to add to this question?
I mean, I would just add and reiterate what I said earlier. I think the best way to see real transformational flagship initiatives happen is if we are very geographic or country specific about some of the transactions and the deals. So, you know, for example, with Kenya, because many of you are familiar with that market, there is a huge potential for utility scale wind, right, and solar, but there's also massive ongoing, but also future opportunities for decentralized distributed renewable energy. And you have a vibrant ecosystem of both Kenyan and African entrepreneurs working with a lot of our partners in the international community. So I think the best way is to Dolphine's point, you know, if Kenya has an ambitious NDC target around renewables, which by the way should really be linked with resilience and sustainable economic recovery amidst COVID, then go bold on that ambition, mobilize the youth movement and say Kenya should double and triple these targets. And by the way, here's how you could deliver it, and here's the ecosystem of partners. And then we, from the different parts of the financial ecosystem that Stacy and Marilyn and I presented, can say, okay, now we have this big, bold ambition for Kenya. Philanthropy, this is your job. You know, you could do de-risking, you could provide early stage capital. Some actually fund incubators and accelerators and entrepreneurs. Some can pool money through any of these blended finance mechanisms. And then all of us work together to unlock private sector money and African Development Bank money as well. So that way, we're not only able to green or make the financing sustainable, but we're also able to activate all parts of that financial ecosystem. That would be my suggestion.
Thank you very much.
I'm going to add to that because I think we can't underestimate. Yeah, I'm just going to add to that briefly. I don't think you can underestimate the need to build capacity across the board, across all kinds of institutions. Right now, a lot of the climate finance and awareness around what counts as green and clean sits in a small number of institutions, and even within those institutions, a small number of people. I'll just tell you one small story. We're doing some work with a big financial institution that thinks that is using the Sustainalytics ESG reports. And we asked a question about what they're doing around climate-related risks. And they take the reports, which are 50 pages long, like they, for each company that they're doing a review on, has a front page of a score, and they just take the score, but they don't read the report. Everybody needs to be able to read a report, to understand it, to know what the stuff means across all institutions and all types of investors. And I don't want to kind of name or shame, that's not the point. The point that I come away with is that there still aren't enough of us who understand what that means. And so I think we need to really build capacity across all kinds of financial institutions and actors and ecosystems and policymakers and the youth movement, et cetera, et cetera.
Thank you for that, for those answers and those very elaborate suggestions. You spoke about okay. I'd like to ask a question. What are the ways to de-risk investments, especially to enable young people to access funding from the various financial institutions? Because our first speaker, Mr. Edward, he actually mentioned a couple of chain. It was basically a chain of processes that young people have to go through, which means basically we have to go through different channels to access these resources, which in as much as it might be a lot of work, a lot of tedious, it also means that there's a lot of resources out there that we need to basically unlock. So how do we de-risk the investments so that to enable young people in each and every one of the processes that I think Edward mentioned, some of those processes, how do we de-risk so to enable young people access financing? Because I think for a country like mine, we usually have the Youth Enterprise Fund at the end of the day. And sometimes when a young person wants to go and get maybe loans to maybe set up an enterprise or a business, there's a lot of requirements that are needed from the bank. The bank wants A, B, C, D, and like some of us, we are still young people below the age of 35, most of us, and we might not have maybe those assets we may not meet those requirements. So to re-emphasize my question, how do we de-risk this investment so that young people, especially who are interested in issues of climate action and advocacy, how do we so that to enable them access these resources? Or possibly for the resources that are already existing, maybe for young people, how do we de-risk so that it complements to what is already there? Yes, thank you.
Can you repeat that question or summarize? It's the question of the youth in particular. How does the youth access the resources for? Okay. Sorry, go ahead.
Oh, okay. The question. Let me just put it to a brief point. How do we de-risk the investments within how do we de-risk the investments to enable young people to access some of these finances?
Do you mean access in terms of starting a new business, or do you mean access in terms of, let's say you live somewhere and you want to put solar on your roof or green your own residential setting or your business or where you work? So access for what purposes? Just so I'm clear, because once again, it depends on the answer will depend on what kind of activity you're referring to.
So if you want to start an enterprise.
Yeah, I don't think so. For starting a new enterprise, it depends if it's a small business or startup. So small business is proven, mature intervention. Think about a restaurant, right? Like we know how that works. We know the pros and cons. Financiers, there's a proven model behind how that works. It's a very low margin business, but we understand it. Versus a startup, which is unproven, highly risky, potentially high growth, and could really disrupt a certain sector or service or product or way of being, so to speak. And so there are financiers that are financing small business, and there are those that are financing startups. And so we don't necessarily have to de-risk that, because there's already there are angels and venture capitalists to do one, the startup side, and then there are small business lenders to do the others. Now, there may be a question of, are there enough? Are there enough of these kinds of investors in the ecosystem to fulfill the demand? And I think that's a different question than de-risking, because essentially you don't need to de-risk what the types of investors who are already looking for that risk, right? But they're looking for some returns, outsized returns for that risk. And for the small business side, well, they're not also looking for, they're just looking for a proven business model. And there's also not a need to de-risk that. You just probably need more of that. Do we have enough of those kinds of investors? And that ties into questions of, as I mentioned earlier, 80% of capital not crossing a national border. So in your economy, are there, the question is, how do we get in every economy the adequate supply of capital for these categories to meet the demand?
Okay. Anyone else like to add?
No, I think what she said, she gave a very good answer. You don't have to de-risk the sector because they already finance mechanisms for that. So are there enough is the major issue we're asking. And for example, you have the Climate Innovation Center that helps youth entrepreneurs and talks to, they have competitions on different projects, clean projects, and they get funding for climate smarter projects or climate-friendly projects. So basically, are there enough? How many more do we need? How much money needs to be put in there? So those are the questions we should be asking, and how finance can be pushed towards youth development, especially not only youth development, but in the climate change space. Thank you.
I'll hand over to Maria.
Yeah, thank you so much. The topic that Dolphine brought up is actually quite interesting in the sense that, for example, in developing countries, the concept of de-risking is really about like private investors coming in and giving money to small businesses and not being assured of a return for their investment. And it's not like the way it's set up in Africa, for example, Uganda, where I'm from, is it doesn't have the sort of enabling environment that's here in the States, where you can account for like the risk factors involved. And some of the time the business will go bust and the investors may not be able to track what happened to the business owners. They can disappear and no one will know where they went. So maybe we shall look deeper and see what can be done at the local level in the developing countries. Now, I wanted to wrap up with one question for all our panelists, and it is that as young people seeking to develop a youth fund, what advice do you have for us in structuring financing instruments and developing a governance framework? And this is also because we are, as we mentioned in the email, is that we are working on developing a fund, and obviously, as young people, we aren't as experienced as the rest of you who have been in this for quite a while now.
Well, I can go first because I need to jump off and speak at another event. I mean, my advice would be first to really figure out the focus and the mission of the fund, right? As Marilyn said, there's a proliferation of funds, but your objective and your mission has to be very clear. If it's a fund for startups and entrepreneurship, then I think you could get a lot of mentorship and coaching from our community of experts and funders. And it's the right time to actually kickstart a fund that will support startups and entrepreneurs, whether it's for clean water or air pollution, curbing air pollution technologies, decentralized renewable energy. And that fund is for startup, for incubation. And the grants will be to first set up the enterprise, and then some concessional money could be available actually for the social enterprise, for the business side of it. That's one suggestion, and I think you can draw on a variety of partners on that, whether it's foundations, some bilateral development agencies like GIZ, which is a big priority in Uganda and Kenya and some of the markets you're working with. It's also possible to establish a fund that is purely for grant making, to influence policy, to support youth organizations, to do campaigns and advocacy and mobilize. An Africa Youth Fund to support that work is also not impossible to support and to create. So, the message is you have to be very clear about the mission of the fund, because it will also impact the kind of investments or grants that the inputs that will flow into the fund as you develop the concept.
Yes, I also have to hop off. So thanks for the question. I echo everything that Athena has said, and I would say you have to be very clear about what problem you're solving. Are you solving for youth unemployment? Is that the thing? Are you solving climate change? Are you solving financial inclusion? Like, what is the exact problem? And be as granular and specific as possible, because you won't be able to solve for everything at once. At least the ecosystem of LPs, so limited partners into your fund, if it's an investment fund, will be very specific on what they're looking for in terms of that problem and solution that you're seeking with the fund. I would also say that I would think about the ecosystem within which the fund lives. So I don't know if it would be nice to cover every single country that is in your network, but it might be helpful to have pilots to start in certain places that do have enabling environments, or on the flip side, have very little enabling environments, whatever you're, once again, going back to the problem you're seeking to solve. And then seeking to scale from there. Oftentimes, there's fund 1, fund 2, fund 3, a sequence of funds that builds on the previous sequence and takes in lessons learned from the previous sequence of funding. And I would also say that based on what I know, you probably want to seek funders or LPs that are upside funders as opposed to downside. So it's very likely that those risk-averse downside, where most of the capital sits, the pension funds, insurance companies, mutual funds, and the banks are going to be very much on the downside. They seek to protect loss and default, versus those that are actually looking for outweighed returns, for outweighed risk, that may be a better sweet spot. But you have to decide all those things. So I would just echo what Athena said and being very clear about all of those parameters, and then seek to raise the fund.
And I wouldn't add to, I think what Athena and Marilyn have said, I would agree with 100%. But I would add what Edward said early on, which is see if you can find mentors to help you in the learning that your target group needs to do to learn how to build a business. Because the business of running a business is not something that everybody knows how to do. Not even, some of us here, right? We work for other people, but it's a real skill to understand kind of the business of running a business. And if you either can get somebody on team who knows that, or you can build that capacity yourself, your probability of success in that business goes way up. Just having a good idea doesn't make it a success. And so definitely limit to the problem you're solving, limit to, don't try and do everything, and figure out the market you're looking at, but also make sure you've got the capacity or the mentors to help you learn how to build a business.
Okay. I like to say that for a youth fund, I think you can start from your different associations. I know there are quite a number of different youth groups. So you can do a pilot with maybe some African countries, West or IE could just set up a fund. And I know that there are a lot of youth that are being funded. They have donors that fund some of their projects. So I think you can start up with such contacts to, and I think the best way to start is creating awareness, a fund to create more awareness and advocacy. So yeah, you can leverage on networks you already have, donor funds that you speak to pull together resources for youth, youth-focused resources for youth activity. I think that'll be a way to go about it.
Oh, thank you very much. Yeah, in just to follow up on what you've said, Ms. George. So when you talk about start with youth organizations, maybe in Africa, in region, so maybe. So would you advise the idea of maybe we start small, like we look at, because I've interacted a bit with the African space. Do you think we could try start with maybe an African fund for youth in climate change? Then we get those who support, then we basically escalate it so that we can also replicate the same, so that it escalates to a global fund. Would you advise that approach?
Yes, I'll advise that approach. That's a very good approach. Starting small and starting with Africa, because there's lots of donor funding coming towards the global south, obviously. So yes, that would be a good place to start.
Oh, so thank you very much for this wonderful discussion. Thank you, Stacy. Thank you, Ms. George, for staying up. Thank you for the other speakers, Edward, Athena, and all the others, and my co-moderators, Jorge and Maria. I think it's time I hand over so that they can have a bit of their last words. Then we can officially close this session. So Jorge and then Maria, then we can call it a day.
Well, I just want to thank you all. This was a wonderful discussion, and I hand it over to Maria so we can close it up, wrap it up.
Yes, thank you all for being here. I know you're all very busy, but thank you for agreeing to be here. We are going to share the recorded version within our networks, and obviously reach out to you once we finish the draft for the fund. And I hope you all have a lovely day then. Bye.